Hello and welcome to View from the Markets. Today we're in Hong Kong and we're joined by Marc Faber, investment advisor and author of a monthly investment newsletter, The Gloom, Boom and Doom Report. Marc, welcome.
Thank you for having me.
Okay, in your latest market commentary, you've said that the US basically has two choices. That's default on its obligations or somehow monetize them and then hope that inflation saves the day. You want them to do the former, but it appears that the latter is the course that the US has embarked on.
Yes, I'm sure they will, before they default, they will monetize, and eventually you get higher inflation rates, not tomorrow, but say in 5 to 10 years' time, and then eventually you have a interest payment problem on the government debt, which will balloon in the years to come as interest rates are likely to go up. And as the government debt expands, especially given the unfunded liabilities arising from Medicare, Medicaid, and Social Security. So I think they have a problem sooner or later. Now, they could, of course, do a dirty trick, and that's partial default, namely not pay the interest to foreigners, but continue to pay the interest on local treasury holders because they are held by Social Security and by state pension funds and so forth. So if they default altogether, it's a total collapse of the system. So usually governments in this situation, what they've done is to monetize and try to get rid of the debt through inflation.
And are there any precedents for this partial?
Oh yes, a lot. You take, for instance, the Weimar hyperinflation years. It was due largely because of the very high reparation payments Germans had to meet. And so each time the government debt or the obligations become burdensome, the way out is to monetize and to create inflation.
In that context, are you dismayed by what we're seeing in the Eurozone at the moment?
Well, not dismayed, because I think that all paper currencies will continue to lose their purchasing power as they have over the last 100 years or so. I think that the bailout of Greece is obviously not favorable for the value of the euro, and I think this bailout will be forthcoming, and then there'll be more bailouts, and the ECB will talk tough and act softly and so forth. So over time, I think that all paper currencies will lose purchasing power, because nobody will want to have a very strong currency to start with, because then they lose some of their competitiveness, as they believe. I don't think so, but that's their belief among central bankers. And therefore, in the long run, the investor has to think very clearly, what asset class do I choose for the next 10 years? US government bonds or government bonds in general, or equities or commodities, precious metals or real estate or collectibles and so forth.
And you've talked about the urgent need to return to some more rational monetary policy. In what sense is today's monetary policy irrational?
Well, I can give you many examples, but basically artificially low interest rates created the credit bubble of the last few years, in other words 2001 to 2007, and the credit bubble then led to the housing bubble in the United States, and we know what the result is. And that was a consequence of artificially low interest rates. Now, after September 2007, the Fed again cut interest rates on the Fed fund rate essentially to zero, and that had some unpleasant and unintended consequences. As an example, before the rate cuts in September 2007, the oil price was at $75. And as you know, in the second half of 2007 and early 2008, global demand for industrial commodities, including oil, was diminishing already. It was still growing in emerging economies, but in the developed world not. But the oil price then still went up from $75 to $147. The result of this increase in oil price was that the total outlays for oil in the US went from $500 billion annually to an annual rate of $1 trillion. So the consumer was faced essentially with an additional tax of $500 billion. And so that probably pushed him even more over the edge in terms of consumption. And now we have these artificially low interest rates, and again they produce some undesired effects and create bubbles somewhere. We don't know yet exactly in what sector, but very clearly when you have artificially low interest rates, you have a misallocation of capital like is happening now in China.
You've also echoed David Stockman's attacks on the banking system, describing the system as bloated and unproductive. Any sign that policymakers are edging more towards your views with the Volcker rule?
Well, I mean, the Volcker rule comes probably too late, and by the time it will have gone through Congress, it will be diluted very strongly. The problem is the political process in the United States, that occasionally there is a good idea, but by the time it gets implemented, it's been attacked by so many different interest groups that it's a compromise, and usually it then leads to bad regulation.
And is Gordon Brown's proposals for some kind of tax on revenues, profits, compensation, is that also in the bad category?
Well, I don't think that you should have in an economic system taxation according to an industry, excess profit taxes on oil companies or excess profit taxes on banks and bonuses and so forth. I think the best would be to have high real interest rates that discourage speculation. Because look, let's say I give you $1 million US. You don't get any interest on your deposit at the present time. So by having interest rates at zero, I essentially force you to speculate in something. I force you to go and buy some real estate or buy some stocks or trade currencies or whatnot. And the whole problem is the artificially low interest rates lead to a complete misallocation of capital, lead to credit bubbles, one here and then one there and so forth and so on. And at the end, eventually interest rates will go up. Maybe they'll stay negative in real terms. In other words, inflation adjusted. I don't think that in the US we will have ever again for the next 10 years real interest rates. In other words, maybe Mr. Bernanke will one day increase interest rates to 5%. But then inflation is maybe 10%, so you have 5% negative real interest rates. And I think that will lead to more speculation. They will lead to inflation in something. Maybe it's real estate, maybe it's commodities, maybe it's the consumer price index.
So in view of this giant global misallocation of capital, where should the smart investor put his or her money in 2000?
Well, I wished I knew precisely. A year ago, markets were deeply oversold and sentiment was extremely negative about equities and commodities. The CRB had collapsed by more than 50% and oil had dropped from $147 to $32. And the S&P had gone down between October 2007 from 1576 to 666 on March 6, 2009. So markets, also emerging markets, were very, very oversold. So the risk reward was actually favorable to buy stocks, given the fact that the central banks would print money and that you had all this fiscal stimulus. Today the situation is different. Today, essentially, we are about where markets should be given zero interest rates, whereby it's very difficult to value anything when interest rates are at zero. Say, I have a company that pays a dividend yield of 2%. In eternity, a 2% dividend yield is very high if interest rates are at zero. So my view is we had this huge run-up in equity prices in 2009. Many markets more than doubled. And now we are in a correction period. We made a high on the S&P on January 19th, 2010 at 1,150. We dropped now from the high to the low by about 100 points. And in some emerging markets, we had corrections of 15 to 20%. I think we can rebound, say, into March, April, but I'm not sure we'll make new highs right away. And then if the S&P drops, say, to around 900, Mr. Bernanke will print even more money, and the ECB is not much better. And so eventually stocks will go up, but likely they will not go up against precious metals. Maybe for a few months and so forth, but in the long run, I think what you can get is like in Latin America in the 80s, in local currency, stocks go up a lot, but in real money, they don't go up.